Hey, good afternoon, everyone.
Good
Good af
afternoon.
Hi, good afternoon, Tia. Good afternoon. How's everybody? I see 7 people here, and let me just quickly check how many are in the forum. Oh, in the forum, I have 6 people. So actually, one more person is here in the collaborate and hasn't, signed into the discussion board yet. So please don't forget to do that ASAP. Now, so we are continuing with the stock valuation. So last time, okay, I have it here. So last time we were talking about the dividends, right? And of course, dividends are generally all most of the cases, dividends are in cash dividends, But the dividends are we talked about this before. It's part of the profit that is being paid out. So actually, it doesn't really matter whether there's a. Uh, I wonder if I talked about this, in the last class, dividend irrelevance. Um, before I do that, uh, and sometimes also paid in dividends are also paid in stocks, which is rare. I mean, they don't. I mean, that would be very rare to pay dividends in stocks or in merchandise, uh, because obviously, if the cash dividend comes out of cash dividends comes out of the profit. It comes out of the profit. But where does the stock dividend come out of? Where does it come from? It's actually, the stocks that the company is internally withholding. So it's called the treasury stock. It sounds like, Treasury Department, U.S. Treasury Department. No, no, no. Companies buy. There are times that the companies buy stocks from the market. So if the company buys their own stocks from the market, that's they have to pay the market price to buy. It's called stock buyback. So companies do a lot of as stock buybacks very often. Why? Because it's simply it's simply math, right? But anyway, if they pay dividends in stocks, uh, uh, it's actually nobody's going to like it. Nobody's going to like it. Why? Shareholders don't like it because it doesn't. It only decreases the stock price. It decreases the or it dilutes the share value. Why? Think about it. Stock is basically stock price. I'll call that. Uh, come on. Yeah, that's better. Still something not right. Stock price today, let's call it S0. But something we already know. Let me use that. You understand what book value per share is, right? Because we talked about this in topic 2. Book value per share is basically total equity value, right? Equity at time 0 divided by number of shares. Okay, that's book value per share. Okay, ruler is coming soon. Okay, I don't have ruler yet. So think about it. If the and the equity at time zero is, this is the paid in capital, paid in. And the paid in capital is, literally, paid in capital is literally what the investors paid in at the time of IPO, right? At initial public offering, right? So if the stocks were sold for $100, right? And if the stocks were sold for $100, and if there were 10 million shares sold, right? The price that was so total equity, in other words, equity at time zero, the paid in capital is, oh, no wonder why. Okay, I'm gonna have to the paid in capital was $1 billion. It has to be $1 billion, isn't it right? If the stock was sold for 100, right? The stock was sold for $100, and there were 10 million shares sold at IPO, right? And then clearly, the paid in capital or paid in equity capital is $1 billion. And the book value per share, of course, then will have to be $100, right? Now, in other words, book value per share is exactly $100 because there was $1 billion paid in, and then 10 million shares were sold. But so the number of shares, 10 million. But if they pay dividend in stock, that means the company is, unless the company is paying it with the in any case, if they are paying, that means there will be, this will go up. That means number of shares will have to go up, right? If they are and so if they are paying 10% of the current, if they are paying 10% as dividend of 10 million shares currently, I mean outstanding, that means there will be 11 million shares, right? If there are 11 million shares outstanding, the problem is this is not 11 shares that brought in $100 per share. It's simply, in other words, the total amount of the equity is still 1 billion, but simply denominator will be 11 million. And obviously you cannot have this. It will have to fall, right? Because you're dividing the same numerator by a greater denominator. the price will fall. And nobody will like this. This is called dilution, price dilution. The price will be diluted and no shareholder will like it. So this is not a good thing, right? Now I see why I was getting. Okay, because this was, it was like this, 100% was like this. I'm gonna have to move out of there. So stock dividend is not a good thing, right? Nobody wants. It will result in price dilution. Okay. Also, sometimes it's very rare if they pay dividend in merchandise. It's very rare. Also, this is a headache. I mean, nobody wants it. If you're a shareholder of Samsung, and if Samsung is paying you dividend in merchandise, like refrigerator, I mean, you would have to have large amount of shares, like for every 100 shares they pay you one dividend in one with one refrigerator. If you have 300 shares, you will receive like 3 refrigerators. Now, what are you gonna how are you gonna pick it up? First thing, unless they deliver it to your home, that's gonna be a headache. It doesn't. And how do you get rid of it? I mean, you will have to. You already have refrigerators. You have 2 refrigerators. You don't need another refrigerator. There's no space in your home to put 3 refrigerators. It's gonna be a hell. You got to get rid of it. You got to cash in. You got to liquidate it. So it's going to be a hell, right? So I'm just, showing you the example that uh, some sometimes they can pay, dividends in stocks and merchandise, but that's ridiculous. Anyway, now preferred stock. Now, as opposed to the common stock, preferred stock is not the true equity, because uh, not true equity, because equity means ownership, um, and so true equity is only the common stock. If you're a common stockholder, you have the voting right. Vote for what? What are you voting? You'll be voting the directors, board of directors, right? If you have, voting right, common holders vote for board of directors in the board of directors, right? And the board of directors will elect chairman, right? We talked about this at chapter 2 or topic 2. So I'm not going to go over this again. And I made it very clear in topic 2 that the ownership and management are separate, right? It should be separate. What I'm saying is it should be separate. But a lot of times, the majority shareholders, they can easily become directors, right? They can easily become directors. They occupy board of directors, and because if you have 51%, you can do pretty much everything with the company, because you have the supermajority. Nobody can Nobody can, veto your power, right? Nobody can veto your decision. So sometimes, and of course, nobody has 51%. It's just the when you pull together, when you ally with friendly shareholders, and the shareholders I'm talking about are majority shareholders. I mean, if you have like not even 1%, you are not in the league. But if you have something like 10%, 11%, 15%, and you just uh, form a pact with, or you ally with other majority shareholders, you can control 51%, and you can vote yourself into the board of director. Most of the board of directors in the board of directors are pretty much the majority shareholders. They become, and then one of them, uh, by the help of the friendly forces, they can even become chairman, and they can also vote themselves into management. They can even vote themselves. But you understand, chairman is the representative of the board of directors who represents the owners, right? Makes sense. But then I've been telling you the job of the board of directors is to hire or fire the management. And then when you can control 51%, the chairman can appoint himself for the CEO. He can appoint himself to the CEO position, and he can also run the company as the management, right? Now, there is double income then. I mean, all the owners receive dividends, right? All the shareholders receive dividends. And if you hold like, 10 million shares, even if they pay $1 dividend a year, your annual income is $10 million. Plus, as the, CEO, you can probably, get, 500,000 salary a year, right? That's why I'm telling you, ownership and management must be separate. But if the chairman is the best person, most fitting person to run the company, who can say no, right? For example, if Steve Jobs was the CEO of Apple, uh, and he was, I don't know if he was a chair, but he was also one of the directors, and he was one CEO in the 90s, and then he got fired by the board of directors, and then he was rehired as a CEO. But during all the time, he was on the board. He was on the board. But when Steve Jobs is when Steve Jobs ran for CEO, and the board didn't deny it. The board, because you can't deny that Steve Jobs was the best person to lead Apple. I mean, until he died in 2021, I believe, 2021. So you have to remember why uh, uh, the ownership control is a very important issue in corporation. Also, that's why I'm saying, preferred stock is not true equity, because preferred stock doesn't come with the. However, preferred stock is often considered, uh, so often considered quasi-debt, quasi or quasi-debt. That means, almost debt, because much like the interest on the debt, it pays a fixed dividend. It pays fixed dividend. So preferred stock is only preferred only because, it's called preferred stock only because it pays dividend before uh, the, uh, the company pays dividend on the common stock. Okay, uh, so the company pays if the company pays dividend on the common stock, it will have to be after the preferred stock. You cannot pay dividend on the common stock before paying dividend on the preferred stock. But preferred stock is unlike debt, that in that it has no maturity date. Of course, debt has always, maturity, right? And therefore, debt is an annuity, right? Bond is an annuity. We all know that. That is an annuity. However, without maturity, but it's like annuity, it's called a perpetuity. Okay, so perpetuity is literally, it's a perpetual thing, and it's an annuity. It's an annuity, perpetual annuity. Okay, now because they have fixed claim on the firm's income, in other words, fixed dividend, right? Fixed dividend that takes precedence over the claim of common stock. Preferred stockholders are exposed to less risk. Yeah, just because you receive dividend um, before common stock, less risk. That's true. However, the main reason of the preferred stock, is the tax shield. Okay, it's the tax shield. My handwriting is like, what can I do? It's because of the tax shield or tax benefit. I'm gonna get to that quick soon. And then, but think about it. Dividend, no matter what, dividend has to come out of, we all understand, dividend has to come out of it has to come out of profit, or EAT, right? So if that means only if dividend is positive, you can pay dividend. If it is negative or zero, you can't pay dividend, right? Regardless of whether it's common stock or preferred stock. So sometimes they cannot pay, if they don't have profit, they cannot pay dividend on the preferred stock, right? But it's supposed to be a perpetuity. It's like debt because it pays fixed, dividend, fixed. But then, when you don't have even the interest on the bond, if the company has no EBIT, right? You remember, if the company has earnings before interest and taxes, right? If this has to be positive to pay interest or coupon payment. If you don't have, if this is zero or negative, you cannot pay that, right? If it is If the case is like that, you cannot even pay interest. Just like that, if this is, 0 or negative, right? If that's the case, you cannot pay dividend, right? You can't help it. But so you can skip dividends for some time, a couple of periods, like, because they don't have a couple of years. But then when their financial situation improves, then and they are, recovering, they are, making profit again, they're profitable again. Then what about the passed up dividends, passed up, or yeah, passed up or held in arrears, dividends in arrears, right? Arrears means, behind in French. Literally, it's obvious, in rear, right? En arrière, that means, behind, in the rear, right? So it's behind. What about the dividends in arrears? Do they paid or uh, do they skip it? There are two types of preferred stock. One is cumulative, the other one is non-cumulative, right? That, it's obvious. Cumulative preferred stock pays all the unpaid dividends, right? Uh, Before paying dividends to the common stock, right? When they are, profitable again. Non-cumulative, forget it. It's gone, right? And this is because, dividend is, this is almost like, common stock in this case, because in common stock, dividend is really an option, right? Even if you're uh, profitable, the company doesn't have to pay dividend, But, if they don't pay dividend, shareholders can recoup all those dividends by selling their stocks. Okay, when they sell their stocks, the higher price, if the company has been profitable, that profit will be reflected automatically in the price of the stock. And then, so when you sell it, you recoup the capital gains. And part of the capital gains is the dividend you might have received if the company paid dividends. Okay, so actually, this brings us to the idea that, think about it, dividend irrelevance. What is dividend irrelevance? Whether they pay dividend or not, it's irrelevant. Why? Think about it. Book value per share at time zero, we already know it's the equity at time zero divided by number of shares outstanding, right? And let's say equity at time zero was 1 billion and number of shares 10 million. Then book value per share at time zero is $100, right? And how does, equity, how do you get to equity at time one? Equity at time one comes from two components. Equity at time zero plus EAT at time one. Okay? So that's equity at time one. Then you divide it by number of shares, which is the same thing. Number of shares do not change, drastically over time. I mean, it would be, number of shares would be relatively constant unless the company sells new round of shares, which the companies generally rarely do. So the number of shares outstanding would be constant. And so this will be book value per share at time one. So basically, we know equity at time zero is 1 billion. I mean, which doesn't change. I mean, it will change, eventually when the company makes a good profit, right? But what if the company makes a good profit, then it will be reflected in the market price, but not the book value, right? Not the book value, because book value is based on uh, what was paid in. Uh, but over time, when market value at every as the market value changes, market price changes, so at least 1 quarter later, one year later, uh, at least equity at time one will reflect the profit. So equity at time one will, of course, then be greater than equity at time zero by as much as EAT. So let's say if EAT at time one is 100 million, right? Then the equity at time one will become 1.1 million, billion, I'm sorry, 1.1 billion. Now think about it. If there are 1.1 billion share, $1.1 as equity at time one, number of shares still 10 million, then what should be the book value per share? It will be exactly, it will reflect, this, so it's going to be $110, right? Now, suppose the company paid out dividend, and so let's say company paid out 50%, as dividend. That means out of 100 million, right? 50 million was paid out as dividend. Okay? And because there are 10 million shares outstanding, per each share, the dividend per share will be $5, right? And on the other hand, after paying out dividend, what is left is retained earnings. And what's the retained earnings? Retained earnings will be 50 million, right? Retained earnings. $50 million is dividend, and then so this splits into a dividend of 50 million and retained earnings of 50 million. So then what's going to be book equity at time one? Then equity at time one will become 1.05 billion, right? And in that case, it's going to be 1.05 billion, right? And then think about it. Then book value per share, if you divide 1.05 billion by 10 million shares, it's going to be exactly then $105, right? Now think about it. If you sold this, you receive $105, and you received $5 in dividends. So eventually it's $110. Eventually it's $110, right? It's the same banana. It's the same banana. In other words, if the company didn't pay dividend, your book value per share would be 110. So you sell it, you receive 110 in cash. If the company paid out dividend, you receive $5 in dividend, right? So you received cash, and you sell your stock, and you get $105 in cash. So the total is still 110. So it's the same banana. That's why they say dividend is irrelevant. It's a theory. Of course, this theory is very solid and quite uh, uh, rational, but in reality, um, what you're selling is not the book value, but market price, right? So the market price would not be exactly like the book value. So you may gain something, right? Even so, dividend is not irrelevant. Uh, and even after receiving dividend, and you may still sell at market price, which is more than 110, or I mean, depending on how this stock is received in the market, right? Uh, Regardless of its true profit, regardless of its book profit on the book, the market is in the short. I've been telling the market is irrational in the short run. Um, so the uh, market price could be different from it, right? Another thing, and after paying out dividend, the price will have to drop. Yeah, that's true. Because part of what would have been reflected in price was already paid out, so the price will have to drop, right? So either book value or market value. The market value would also reflect um, uh, the dividend. The market price will also reflect that by lower price after dividend. After dividend is called ex dividend. Okay, ex dividend price will go down, right? Ex dividend price will go down slightly. I mean, again, if the company is very hot, everybody wants to buy this company, then uh, this drop may be, insignificant because the market price is still, very high. So sometimes, once again, here we have to consider, we'll have to think about the concept of bubble. So we all understand what bubble is, right? What's the bubble? It's irrational price. Irrational price. Um, Now, all the bubbles are, subsiding. All the bubbles are fizzling out. Why? Because of this high, uh, as the Fed is raising interest rate, and if the interest, think about it, interest rate is basically the discount rate. Um, so if interest rate goes up, the valuation will have to go down because discount rate is higher, right? So that's why the um, market has been going down. All these I mean since January 3rd, and January 3rd was when my portfolio was at its highest value. Since then, my portfolio lost 12%. This is ridiculous. Um, Especially I have a lot invested in Nasdaq ETFs, and Nasdaq is the one that and um, that is getting more severe hit than S&P 500 or Dow Jones. And I also have in Dow Jones and S&P 500. So that's why overall 12%, NASDAQ alone, almost 40%. That's just, like back in 2008. And the financial crisis, during the financial crisis, overall market lost, 40%. That's, all including S&P 500, Dow Jones, NASDAQ. Uh, Now it's not like, that bad, but what I'm saying is, NASDAQ alone, NASDAQ alone went down, like by almost 40%. So that's crazy. So, but during the normal economy, right? If the company has been doing well, in other words, whether they do well or not is reflected here in EAT. And there are companies that are doing well, and prices are going up, and it may not be the bubble, but there can still be some bubble. And there are companies that are not even doing well in terms of EAT, but still a lot of bubble in it. So how we know, how we can tell whether it is due to bubble or not due to bubble, but whether it is due to some solid growth, we can tell. The metrics for that I'm going to be talking about later, further down the road. But for now, so dividends on the preferred stock, okay, cumulative or non-cumulative, and then IPO, going public. Now this is what all companies, startups are all startups want to do IPO, initial public offering. It means selling stocks to the public for the first time. So until you go public, you are a privately held company. Privately held company means you cannot sell stocks to the stock exchange. You're not listed in the stock exchange, so you cannot sell stocks in the regular stock market. Of course, privately held companies are also traded over the counter. That means not in the stock market, but over the counter. And those stocks are generally called penny stocks because they are unknown companies. Their stocks cannot be traded at prices like $50 or anything like that. Penny stocks are not really selling for a penny. I mean, anything around below $1 price, $1 or $2, that's penny stock. Okay, so we're out of time, so we cannot talk about public offering, but we're going to be talking about this in the next class, which will be and and as I said, if the company has gone public, they will sell stocks through the public offering, meaning through the stock market. But they cannot sell it at their whim. In other words, I've been telling you, the number of shares outstanding is relatively constant. Okay, number of shares outstanding is relatively constant. Why? Because they cannot sell stocks. The company cannot sell stocks anytime they want, right? Because first of all, if the number of shares increase drastically, let's say number of shares double, let's say it doubles, right? If the number of shares double, what's going to happen to the price? The price will be halved. Why? Unless there is a huge demand that can absorb this twice as many shares in the market. I mean, if the demand is twice as much, then if they double the, a number of shares, it will be all sold in the market, sold to the investors at the current price. The price won't, go down. But let's say the demand is very weak, but they just double, the number of shares. So double the supply, but the demand is the same. What's going to happen? The price will have to go down. The price will drop by half, 50%. So that's why the company doesn't increase their number of shares. They don't increase the number of shares outstanding in the market. They cannot do that because no stockholder likes it, and the company doesn't want it either. And so what is then being sold in the market? Again, it's not once the stock is sold at IPO, right? Then after that, the trading happens between one individual and another individual. It could be individual or institutional investors. But if I was holding Apple stock, but if I sold, another buyer will buy it, right? So that's called the trading. And that way, total number of shares don't increase or decrease. It can only decrease if the company buys back those shares. And I told you, it's called stock buyback. And if company buys back the stocks, the intention is to increase the stock price. Think about it. If the company buys back, then there will be less number of shares. There will be less number of shares outstanding in the market. Now, if there are less number of shares, but same equity, total equity, right? Same dollar amount of equity, you divide it by smaller number, the price will have to go up, right? That's the only reason the companies would buy back. But otherwise, trading happens between one individual, one investor, and another, right? It's called the secondary market. Okay. IPO is called primary market. So only at IPO the transaction happens between the company and the investor. But after that, all transactions are in the secondary market, which is between one investor and another investor. Okay. All righty. So that's all the time we have. If you have any questions, please email me. I have to get ready for the next class. So, okay. All right.
Thank you.
All right. You're welcome, Tia.
Thank you, Professor. Have a good day.
Thank you.
Take care, Maria and Claudia. Yeah. Take care, everyone. Have a great afternoon. All right. Stop recording.